Namaskar, welcome to Kalam IAS. This is NewsKase provided by Kalam IAS to you. Now in NewsKase we discuss one important topic that was there in news in the past 1 week, and this week's important topic is are actions taken by RBI may restrict credit growth in India. The statement and the report was given by S&P Global. Now there is an organization S&P Global. So S&P Global said that the actions taken by RBI, which are restrictive in nature for the financial institutions, may affect credit growth in our country. So what were the actions which were taken by the Reserve Bank of India? So if we look at the actions taken by RBI, the actions are, the first, we saw last month that the Paytm Payments Bank was, debarred and was restricted from onboarding new customers. So there are a lot of, issues were there in the financial institutions because of the actions by RBI, and a lot of hue and cry in the financial market that RBI is too strict on the Paytm Payments Bank, but RBI did not, deter away from its decision. And the other decision taken by RBI was 90 lakh rupees penalty on different cooperative banks. It was taken just 3 days ago. And recently IIFL, it's a financial organization, IIFL was barred from disbursing gold loans. So RBI has been very strict to the financial institutions which are not adhering to the guidelines which are given by the RBI. So there are KYC norms, there are different guidelines which are provided by RBI for the gold loans. So whenever a financial institution is giving a gold loan to someone, then that institution has to adhere to the guidelines provided by the Reserve Bank of India. But the IIFL did not adhere to these guidelines. As a result, the IIFL was barred from giving any more gold loans to anyone in our country. And similarly, Paytm Payments Bank was also given a lot of, the ATM Payments Bank was also given a lot of chances to improve the mistakes that it was making. We have seen that we were getting credit from Paytm Payments Bank. We were able to open accounts without the proper KYC. The documents were not verified. The PAN card was not linked with Aadhaar card. Still, the Paytm Payments Bank was opening accounts of the people just for increasing its market. And as a result, RBI said that you have to get the KYC done, otherwise you have to close the accounts. And Paytm Payments Bank did not adhere to the guidelines provided by the RBI, the directions provided by the RBI. So RBI took a strict decision, and RBI said that Paytm Payments Bank cannot onboard any new customers. It cannot increase its customer base any further. So the S&P Global has said that such actions by Reserve Bank of India might hurt the credit growth in our country. Now, first we have to understand why RBI took such decisions. Why RBI has become more strict towards the financial institutions. The ultimate purpose, the first purpose is to improve compliance. The RBI provides the guidelines and the institutions are not adhering to it. Now they are like, we are very too important for the RBI to take action and hurt the financial inclusion in our country, because one of the goal of Reserve Bank of India is not just to regulate the financial institutions, but also to increase financial inclusion in our country. Now, if the banks are not complying with it, they were having a very merry-go attitude about it that, we are not complying with it and RBI is not going to take very much strict decision. They might give us some penalty, we will pay the penalty, not a problem, but we just want to increase our customer base. This was the attitude of Paytm Payments Bank. But RBI was very strict on it that it might hurt the financial discipline in our country. So RBI said that compliance has to be there. Whatever the guidelines we are providing, the compliance has to be there. If you are not complying with our guidelines, then we are going to take very strict decisions. So to improve compliance and increase transparency in the financial market, in the financial system, increase transparency. How do you increase transparency? By submitting different forms and submitting different documents, as well as the information which are required by the RBI from the banks and the financial institutions. Other purpose for the strictness of RBI is customer safety. We have seen a lot of financial institutions were using customers' money very unlawful and illegal way, and that had resulted into failure of those financial institutions, and the customers' money, the people who were saving their hard-earned money in the financial instruments provided by different financial institutions, that money was taken away by crooks. As a result, the RBI has become very strict and ensure that the customers' money should be very safe. At the same time, it strengthens the financial stability in our country. If the compliances are strong, if the institutions are adhering to the guidelines provided by RBI, the norms provided by RBI, then the financial stability in our country will remain stronger, and it will curb the excessive lending practices, financial institutions to increase the market. For example, banks or NBFCs, financial companies, to increase their market share, they lend money to anyone and everyone. And if they are doing that without proper KYC, without proper credit worthiness, that might give them some returns in short term, but in long term it hurts the economy of the country, it hurts the financial stability of the country. So the RBI has become very strict, and it is curbing the excessive lending practices. For example, IIFL was engaging in excessive lending on the gold loans. IIFL was giving very huge amount of gold loans without proper KYC and without proper KYC and without proper their credit worthiness, and as a result it hurts the financial stability of the country. So RBI has taken very strict decision against them. Now the problem faced by the economy because of such RBI decisions, it has several threats to the economy. Now what are the threats? First is, it raises the cost of capital of financial institutions. So a lot of financial institutions depend upon other financial institutions. For example, an NBFC, a housing finance company, will take money from bank, for example Yes Bank or HDFC, and give that money to the people who want to build a house. Now, if the RBI becomes very strict on the NBFCs as well as on the banks, as a result, the transactions between banks and NBFC will reduce. And in other terms, if the RBI stops, the Paytm Payments Bank from onboarding new customers, that means Paytm Payments Bank cannot raise money from the people. And as a result, the cost of raising funds for the financial institutions will increase. So the cost of capital for financial institution increases, and if the cost of capital for financial institutions increases, then they will charge higher interest rate to the people, and as a result, the demand for credit in the economy will reduce. And that is why S&P Global has said that the credit growth in 25 might reduce from 16% to 14%. In 2024, the credit growth was 16%, and the S&P Global has said in 2025, this credit growth might reduce to 14%. And overall reduction in credit growth hurts the GDP growth rate. How does it hurt the GDP growth rate? Is that whenever the credit growth in our country reduces, that means businesses cannot, are not acquiring enough money to invest. And if businesses are not acquiring enough money, if businesses are not taking credit to invest in our economy, that means the infrastructure development, the development of production capacity of the country and employment, everything will reduce. And as a result, the GDP of our country, the growth rate of GDP of our country will also be affected. So, S&P Global has said the strict actions by RBI might hurt the GDP growth rate our country, but RBI still says that this is very necessary to ensure that the economy is not inflated and the GDP growth rate is not, it should not be unsustainable. The GDP growth rate does not has to be high, it has to be sustainable. If it is sustainable, then India will continue to grow for more number of years compared to, excessive lending by IIFL or, without KYC onboarding customers by the Paytm Payments Bank. So, this was it from my side today. Thank you very much.